Traders will obsess over their trade entry, but they won't give a second thought to where they'll place their stop loss. And if we can agree that managing your trading risk is job number one for a trader, then we can agree that it's vital to know when to get out of a trade gone bad. And one huge issue is that many traders will place their stop in a location where the trade is still valid because it means that they can have a larger position size. You probably recognize this type of protective stop loss. The textbooks will tell you to place your stop loss right under support because if its support breaks, your trade's no longer valid. It'll also allow you to use a higher position size, which to most traders is something they support because they're undercapitalized. The problem is that this protective stop ignores basic fundamentals of how markets operate. So in this example, price came down to support, formed a trading range above support, and then took off to the upside. It's a perfect example of a continuation play, but rarely do we see such clean levels in the real market. The market's not orderly, and there's a lot of noise in the market that you must account for. So when looking at obvious levels, you should be expecting that attention will be paid to it by many traders, especially those who can really move the market. Novice traders, and in fairness, more experienced ones as well, they're going to use these textbook locations, and a cluster of stops will be sitting there ripe for the pickings. This here is what a more accurate representation of these zones will look like. What occurs is probes below the lows and the clearing out of stops sitting right below support. Now, how often has that happened to you? So you think for a moment, what happens at these levels? Number one, traders positioned long are taken out and their stops, which are sell stops, get triggered. Astute traders buy these flushes below support, gaining a position at a favorable price. Number three, traders still holding longs get the benefit of stopped out traders buying back in, which just propels their trade into profits. This is a natural evolution of price, and as a trader, you should seek to avoid these flushes by placing your stop in an area out of the way of the natural movements and the volatility of price. Now, we can never know what's to come in the market, but we can easily see what has occurred. So using this type of knowledge can give you an objective stop loss placement as well as respecting current rhythm, the volatility of the market. This will force you to use a smaller position size, which many traders will take issues with. But here's a quick question here. If you're flushed out of a trade and then the setup is still valid, will you re-enter? Now, if you answered yes to that question, which is going to depend on your trade plan, of course, have you added up the cost of the trade and the loss plus the potential second loss to see if close stops cost you more in the long run? Now, markets have a usual ebb and flow, which can really change depending on who is involved in the market, and respecting that will have your stop in a position in tune with the market. Measurements of market swings. Now, markets have swings against a trend and then continue in the direction of a trend. These swings represent the current volatility of the market and can be used to place your stops outside of the natural flow. Now, no method is perfect, and I'm going to highlight some of these issues later. Now, there's a swing highlighted by the green arrow where we've measured the distance in price of the swing. It's projected from the circled low and is a potential stop if a trade's taken short. So price rallies, it finds resistance, which is more evident on lower time frames, but you can infer it from the price action here. And shorts obviously occurred. Price plots a higher low, rallies again, takes out stop in the immediate area of the previous high. The second rally is part of the complex pullback, but we wouldn't have known that at the hard right edge. So stops are taken out, and as evident by the large red candle after stops were taken, traders pile into the shorts once again. Now, if you took the close stop, you were taken out. However, if you respected what a normal rally was in this market in the recent past, you'd have sat through some drawdown only to be pushed quite hard into your profits. Now, here we have virtually no swings, even close in size to the initial swing, which can pose a position size issue depending on your account size. A short sets up in the area of former support zone, now broken, and if we project from the low prior to the rally, our stop is quite a distance away. Depending on your account size, this may be a trade you'd have to pass on if your plan calls for this type of stop loss. Now, is this even a short trade that you take? If you're shorting a rally, are you shorting every rally, or do you qualify that trade depending on the previous impulse move? Now, after support broke, it was a quick retest after a shallow impulse move, plus having basing under support break, it's not really conducive to a strong continuation move. And as I mentioned, it's not a foolproof stop loss method. However, it's quite objective, and it does respect the moves of the current market conditions. It can provide large stops, which may turn off many traders, but in the end, it is in tune with acceptable moves in the conditions that you're trading in. Our second one is an ATR volatility stop loss. This is another objective and viable stop loss method using the average price range of the market you're trading. I think it's more objective than the previous method, but you'll still have to determine where you project the range from after the ATR has been calculated. Now this is from the first example, and the former stop is the white line. I've used the 20-period ATR calculations times 2 and calculated the new stop loss from the closing price of the entry candle. Now a few things here to note. The trade entry is at the close of the candle that breaks the low of the pivot high candle. Note the yellow line. ATR stop loss is calculated from the closing price of the entry candle. Will you use the closing price, the high, or the low price? There's arguments for all three of those. But whatever calculation you use, it's imperative that you're consistent in all of your trading. Neither are low-risk trading stops. And then you've probably heard the following. This is a low-risk trading setup. Well, what does that really mean? There's simply risk. The only way a trade can be low risk is if you are using a smaller risk percentage than you usually do. If you're jumping around in the risk percentages you're using, you're breaking one of the main rules of trading, which is be consistent. And I personally would not use a different risk percentage unless it was part of the trade plan for a particular setup. For example, trading a failure test of highs may have a lower initial risk because I'm expecting there will be another failure test before the trade gets going. But it's certainly not a low-risk trade. And if you're using the two methods outlined, you may find you must sit aside on certain setups because in order to accommodate the larger stop, you must trade a lower position size. This obviously means your win dollar amount is going to be lower. The bottom line is that these two ways of setting your stop loss are mostly objective. They keep you out of the noise, and more importantly, they respect the market conditions that you're trading in. And I want to invite you to download this free indicator blueprint that NetPicks has put together. It's complete with videos. It's free. You'll be looking at indicators a little differently, and you can click here to download it. Once the markets find a consolidation area, you now have the opportunity to play a support or resistance holding or failing type of play. 4 types of trades, and there are literally hundreds of ways that you can take advantage of these trading opportunities. In this chart here, there's a move that we see time and time again because it's the nature of the markets. What occurs here is during the markup phase, that big green candle attracts the eyes of traders who jump in the move. And these traders are actually late to the party because more astute players are in the move prior to the break. You'll notice in the accumulation area, immediately prior to the break, we have price sitting up against resistance in a 2-candle range. This is an opportunity for a trade where you think one of two things will happen. Number 1, resistance will hold and you play a short back into the consolidation. Number 2, resistance will fail and price will rally to the upside. And while some traders will use a rate of